So you probably saw the headlines. Figma's stock took a nosedive, dropping over 15%. And this is right after they posted some seriously impressive growth numbers. It doesn't quite add up, right? So what is going on here? Well, that's what we're going to unpack. We're going to dive right into their Q2 earnings report, look at the numbers they presented, and really figure out why Wall Street is so spooked when, on the surface, things look so good.
Okay, so the first thing you see when you open up their report is this massive number, 41%. I mean, wow, that's their year-over-year revenue growth. For a company of Figma's scale, that is absolutely fantastic. So that brings us back to the big question. Why the panic? If growth is this strong, what are we missing? Clearly, there's more to the story than just this one number. Let's start digging.
All right, first things first. Let's look at those big, shiny headline numbers. And I gotta say, at first glance, they look incredible.
Get this, they brought in almost $250 million, $250 million in revenue just for Q2. That tells you demand for their platform is just on fire.
And it's not just small users. Look at this number, almost 12,000. That's how many customers are paying Figma more than 10 grand a year. That number is up a whopping 31%. It's a huge signal that they're not just a tool for freelancers anymore. They're landing those big, beefy enterprise contracts.
And of course, the CEO, Dylan Field, has this big, sweeping vision for the future. He's saying, hey, as software eats the world, design and brand are going to be more important than ever. It's a great story, right? It paints this picture of long-term dominance. But here's the catch. This quarter, it seems like investors weren't really buying the long-term story. They were looking at something else entirely.
Yeah, because when you peel back that top layer of incredible growth, you start to see a few other metrics. And these numbers, well, they're telling a very different story. A story about profit just vanishing.
So let's circle back to that main question, right? How can you have 41% growth and a stock that's in free fall? What did the market see that we haven't yet? You know the saying, the devil is always in the details.
And here is the smoking gun. Take a look at this table. Specifically, that top line, non-GAAP operating margin. In Q1, it was a pretty healthy 18%. Not bad at all. But in Q2, it fell off a cliff, all the way down to just 5%. I mean, that is a staggering drop in just one quarter. And then you look below it, at net dollar retention. It's still good, don't get me wrong, but it also took a little dip. It's that 1-2 punch that really got investors' attention.
Then just in case you're not a finance nerd, let's quickly break down net dollar retention. Basically, it's a super important number that asks, are our existing customers spending more money with us this year than they did last year? It includes everything, upgrades, downgrades, people leaving. So anything over 100% is great. It means you're growing your business without even signing up a single new customer. 129% is still awesome. But seeing it tick down, even a little, at the same time your profits are collapsing, yeah, that's going to raise some red flags.
Okay, so we have to figure this out. Why? Why did profitability just evaporate in 3 months? It's time to decode this profit puzzle. And this is where things get really interesting. A little bit of accounting fun for you. See that 5% margin we talked about? That's the non-GAAP number. It's an adjusted figure. If you look at the official by-the-book GAAP number, their margin was just 1%. They were barely breaking even. So, what's the difference? What are they adjusting out to make the numbers look better?
Well, that gap between the 1% and the 5% is mostly made up of stuff they decide to exclude. And the biggest piece of that puzzle, the single largest adjustment they make, is something called stock-based compensation. Boom, there it is. Over $7 million in stock-based comp. Now, you might think, well, that's not real money, it's not cash leaving the bank, and you're kind of right. But it's a very real cost for shareholders because it dilutes the value of their shares. Companies love to pull this number out to make their day-to-day operations look more profitable. But right now, the market is obsessed with real profit, and they're definitely not ignoring this.
So, okay, we've established the what. Spending is way up, profits are way down. But the why is just as important. And this isn't some accident. It's a choice. A very intentional and very, very expensive bet on the future.
Think about this. In 2025 alone, Figma basically doubled the number of products they offer. They launched 4 brand new major products. That's just a massive undertaking. It means hiring tons of engineers, spending a fortune on R&D, and then even more on marketing to tell everyone about it. And every single one of those dollars comes directly out of their profit margin.
And if you had any doubt, just look at what they put in their own earnings presentation.
Quote, investing in AI, long-term focus, willing to take big swings. They're literally screaming it from the rooftops. They're telling Wall Street, look, we are sacrificing today's profit for tomorrow's dominance. It's the age-old Silicon Valley story. Growth now, profits later.
And that puts you, the investor, in a really tough spot. It creates this huge dilemma. Do you buy into that long-term vision, or do you get scared off by the very real, very high costs of that vision today? And to be fair, Figma isn't hiding the risks. If you read their official filings, they lay it all out there. They say, our past growth might not happen again, our results are going to be bumpy, and the competition in AI is absolutely fierce. They are flat out telling you, this big bet we're making, it might not pay off. So that's the multi-billion-dollar question, isn't it? Is all this spending a genius move, a necessary investment to become the undisputed king of design for the next decade? Or is it a dangerous gamble, a sign of unsustainable spending in a new world where investors demand profit, not just promises? Honestly, the answer to that question is why Figma stock is on such a wild ride. And it's what everyone is trying to figure out.